Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, mortgage broker, or attorney. This presentation is for educational and informational purposes only and should not be considered financial, legal, or investment advice. The housing and mortgage market is complex and subject to change. Always consult with a qualified professional before making any major financial decisions. You see it, the one. You've been scrolling Zillow for months, maybe even years. You've seen the good, the bad, and the bizarrely decorated. But this one is different. It has the open kitchen, the backyard for the dog, the extra room you can finally turn into a home office. You can already picture where your couch will go. Feels like home. And then reality hits like a ton of bricks. The price tag, the down payment, the one giant terrifying word that stands between you and the keys to that front door. The mortgage. Suddenly, that dream feels a million miles away, buried under a mountain of paperwork, confusing acronyms like DTI and LTV, and the paralyzing fear of making a mistake that could cost you tens or even hundreds of thousands of dollars over the next 30 years. Let me tell you a secret the banks don't want you to know. That confusion is not an accident. It's a feature, not a bug. The traditional mortgage process in the United States is designed to be overwhelming. It's built to make you feel small, to make you feel like you have to accept whatever terms they slide across the table. But that ends today. Right here, right now. Over the next 10 parts, we are going on a journey together. This isn't just another video with a few surface-level tips. This is the definitive A to Z playbook for conquering the American mortgage system in 2026. My promise to you is simple. By the end of this series, you will not just understand the mortgage process. You will master it. You will walk into a lender's office not with fear, but with the confidence of an insider. You will know the questions to ask, the traps to avoid, and the strategies to secure the best possible loan for your dream home, saving you an incredible amount of money and stress. We are going to turn you from a mortgage applicant into a mortgage expert. The home buying landscape of 2026 is a completely different world than it was just a few years ago. The wild, unpredictable interest rate swings, the shifts in housing inventory, the new lending standards. It's a minefield for the unprepared. The old advice your parents got simply doesn't apply anymore. You need a modern strategy for a modern market, and that is exactly what we are going to build piece by piece. So where do we start? We start by building your foundation. Before you ever talk to a realtor, before you even think about applying for a loan, you need to become what lenders call a bulletproof borrower. This means getting 4 key areas of your financial life in perfect alignment. I call these the 4 pillars of mortgage readiness. Get these right and everything else becomes 10 times easier. Get them wrong, and you're starting the race with your shoelaces tied together. The first pillar is the most famous one, your credit score. You've probably heard you need a good score, but what does that actually mean? For a mortgage, your FICO score is king. And it's not just one score. Lenders will pull your score from all 3 major bureaus, Equifax, Experian, and TransUnion, and typically use the middle score for their decision. Think of your credit score as your financial report card. It tells a story of your reliability. A score below 620 makes getting a conventional loan extremely difficult. A score above 740, or even better 760, puts you in the top tier. This is where you get the best interest rates, the lowest fees, and the most favorable terms. The difference between a 680 and a 760 score might not seem like much, but on a $300,000 mortgage, it could literally save you over $50,000 in interest payments over the life of the loan. That's a new car. That's a college fund. It's real money. Your mission starting today is to know your scores and take concrete steps to polish them. Pay every single bill on time every time. Keep your credit card balances low. Ideally below 30% of your limit, but below 10% is even better. And don't open or close any new lines of credit in the 6 to 12 months before you plan to apply. Lenders hate instability. The second pillar is your income. This seems obvious, right? You need a job to pay the mortgage. But lenders look at it with a much more critical eye. They're not just looking at how much you make, they're looking for stability and consistency. A brand new job in a new industry? That can be a red flag. A recent promotion with a big raise? Fantastic, but they'll want to see proof that it's stable. For most lenders, the gold standard is 2 years of consistent employment history, preferably with the same employer or at least in the same line of work. If you're self-employed or a freelancer, the bar is even higher. You'll need to provide at least 2 years of tax returns to prove your income is reliable, and not just a one-time fluke. The key takeaway here is this: your income needs to be verifiable and predictable. Start gathering your documents now. W-2s, pay stubs, tax returns. Think like an underwriter. You need to build an undeniable paper trail that proves you are a reliable earner. Pillar number 3 is assets. This is the cash you have on hand for the down payment and closing costs. And this is one of the biggest hurdles for homebuyers in 2026. For decades, the standard advice was to save 20% for a down payment. And while putting down 20% is still the best way to avoid private mortgage insurance, or PMI, it is not a requirement for owning a home. Let me repeat that: you do not need 20% down. There are conventional loans available for as little as 3% down, and government-backed FHA loans for 3.5% down. We'll dive deep into all these loan types later in the series. But for now, know this: you need to have your down payment money plus extra for closing costs, which can be anywhere from 2% to 5% of the purchase price, sitting in a bank account seasoned and ready to go. Seasoned is bank speak for money that has been in your account for at least a couple of months. A large sudden deposit of $10,000 from an unknown source a week before you apply is a massive red flag. They want to see that you saved this money legitimately, not that you borrowed it from a friend or took out a cash advance on a credit card. Start saving now and keep that money in a dedicated, easy-to-track savings account. And that brings us to the fourth and final pillar: debt. This is the silent killer of mortgage applications. You could have a great credit score, a solid income, and a hefty down payment, but if your debt is too high, you will be denied. Lenders look at your debt through a specific lens called the debt-to-income ratio, or DTI. This is, without a doubt, one of the most important numbers in the entire mortgage process. It's a simple percentage calculated by taking all of your monthly debt payments, your car loan, student loans, credit card minimums, any other installment loans, and dividing it by your gross monthly income, which is your income before taxes. For example, if your monthly debt payments are $2,000 and your gross monthly income is $6,000, your DTI is 33%. Lenders have very strict limits on this number. Getting this ratio under control is non-negotiable. Credit, income, assets, and debt. These are the 4 pillars. They are the foundation upon which your entire home buying journey will be built. Your mission for the next few weeks is to take a brutally honest look at each of these 4 areas. Pull your credit report, organize your income documents, calculate your available assets, and add up every single one of your monthly debt payments. This is your starting point. This is your personal financial snapshot. So you know the 4 pillars now, the fundamental building blocks of a successful mortgage application. But there's a secret 5th element, a hidden force that connects all of them. It's a series of calculations and ratios that lenders use to decide not just if you'll be approved, but for how much. It's the hidden math that determines the size of the home you can actually afford. And in our next part, we are going to pull back the curtain and reveal this secret formula. We're going to give you the keys to the kingdom, showing you exactly how to calculate your true purchasing power before you ever speak to a bank. So let's get right into it. The entire mortgage qualification process, the thing that feels like a mystery box guarded by bankers, boils down to 2 simple numbers. That's it. Just 2. These numbers form what's called your debt-to-income ratio, or DTI. This isn't just a piece of jargon. It is the mathematical soul of your mortgage application. It's the first and arguably the most important test you have to pass. Think of it like this: your income is your power. It's the engine that drives your financial life. Your debt is the weight that engine has to pull. The bank's only real question is your engine powerful enough to pull the existing weight plus the giant new weight of a mortgage without breaking down? Your DTI ratio is the number that answers that question. Now, there are 2 parts to this DTI calculation. The first is called the front-end ratio, and the second is the back-end ratio. Most people only ever hear about the back end, but understanding the front end is your first secret weapon. The front-end ratio looks at just one thing: your future housing payment. Lenders have a golden rule, a guideline they've used for decades. They don't want your total housing payment to be more than 28% of your gross monthly income. That's your income before taxes are taken out. Let's make this real. Let's say you and your partner, if you're buying together, have a combined gross annual income of $120,000. To get your gross monthly income, you just divide that by 12. That gives you $10,000 a month. Now we apply the 28% rule. We take that $10,000 and multiply it by 0.28. That gives us $2,800. According to the standard front-end ratio, your total monthly housing payment should not exceed $2,800. But what exactly is in that total housing payment? This is a critical detail. It's not just the mortgage itself. It's an acronym you need to burn into your memory: PITI. P stands for principal. That's the part of your payment that actually pays down the loan amount. You borrow $400,000, this is you paying that back bit by bit. I is for interest. This is the bank's profit. It's the cost of borrowing their money. In the early years of your loan, this is the biggest chunk of your payment. T is for taxes. Property taxes. You pay these to your local city or county to fund schools, roads, and fire departments. The lender estimates this annual cost, divides it by 12, and adds it to your monthly payment. And I is for insurance. Homeowner's insurance. This protects the house, which is the bank's asset, remember, against things like fire or storm damage. Again, they take the annual premium, divide by 12, and add it to your bill. So PITI is your total all-in, no surprises monthly housing cost. And based on our front-end ratio, for someone making $10,000 a month, that number is $2,800. Okay, pretty simple, right? But that's only half the story. And frankly, it's the less important half. The real gatekeeper is the second number, the back-end ratio. The back-end ratio asks a bigger question. It asks, what is the total of your new housing payment plus all your other existing monthly debts? This comprehensive number, this total of all your fixed monthly payments, is what the bank really cares about. And for this, the magic number isn't 28%. For most conventional loans, the absolute ceiling, the line in the sand, is 43%. Some lenders prefer to see it under 40, but 43% is generally the hard stop for what's called a qualified mortgage. So let's go back to our example. Your gross monthly income is $10,000. We multiply that by 0.43. That gives us $4,300. This is your absolute debt ceiling. The bank is saying, based on your income, we are not comfortable with you having more than $4,300 in total monthly debt payments, your new house included. Now, what debts do they count? This is where people get tripped up. The bank will pull your credit report and add up the minimum monthly payments on every single debt they see. This includes car payments, student loans, credit card minimum payments. Even if you pay it off every month, they count the required minimum. Personal loans, any other installment loans. What does it not include? Your cell phone bill, your utilities, your car insurance, your grocery budget, your Netflix subscription. They are only looking at payments for money you have borrowed. So let's build out our scenario. You make $10,000 a month. Your back-end debt limit is $4,300. Now we have to subtract your existing debts. Let's say you have a $500 car payment, a $300 student loan payment, and across a few credit cards, the combined minimum payments are $150. So $500 plus $300 plus $150 equals $950 in existing monthly debt. Now we take your debt ceiling, $4,300, and we subtract that $950. What's left? $3,350. This number, $3,350, is the actual maximum PITI payment the bank believes you can afford. Notice something? The front-end ratio told us you could afford $2,800. But the back-end ratio, after accounting for your other debts, says you can afford $3,350. So which one does the bank use? They will almost always defer to the more restrictive of the two calculations. In this case, your car and student loans aren't high enough to be the limiting factor. But imagine you had a $1,500 car payment. Your back-end calculation would allow for a much smaller house payment, and that would be your new limit. The bank runs both calculations and you are bound by whichever one gives you a lower number. Okay, so you know your maximum PITI payment. Let's stick with that $2,800 number from the more conservative front-end ratio. But what does that mean in terms of a home price? This is the final step. This is how you turn a monthly budget into a Zillow search filter. Your $2,800 PITI payment is made of 4 parts, remember? 2 of those parts, principal and interest, depend on the size of your loan and the interest rate. The other 2, taxes and insurance, depend on the price and location of the house you buy. So you have to work backwards. First, you have to estimate your taxes and insurance. A good national average for property taxes is around 1.1% of the home's value per year. Homeowners insurance can vary wildly, but let's budget $1,800 a year, or $150 a month, for a decent policy. Let's say you're looking at homes in the $450,000 range. Your annual property taxes would be around $4,950, which is $412 a month. Add your $150 for insurance. That's $562 a month just for the T&I in pity. Now we take your maximum pity payment, $2,800, and we subtract that $562 for taxes and insurance. You are left with $2,238. That is the maximum amount you can spend on principal and interest or P&I. This is the number that dictates your loan size. At a 6.5% interest rate on a 30-year fixed loan, a monthly P&I payment of $2,238 supports a loan amount of roughly $354,000. So you combine that loan amount with your down payment. Let's say you have $100,000 saved. A $354,000 loan plus a $100,000 down payment means you can start looking at homes priced around $454,000. And just like that, you've done it. You've reverse engineered the bank's formula. You've gone from a vague salary number to a concrete home price you can actually target. This isn't a guess. This is the math. This is the code. You now know your true purchasing power before a lender ever looks at your file. You are no longer flying blind. You are in control. But this entire calculation, this beautiful logical formula, hinges on one single powerful variable we haven't talked about yet. It's the variable that dictates whether you get a 6.5% interest rate or a 7.5% rate. A difference that could lower your purchasing power by $50,000. It's the number that can get your application approved with a higher DTI or denied instantly, no questions asked. It's your credit score, and it is far more than just a 3-digit number. It is the gatekeeper to everything we just discussed. In our next part, we are going to demystify the credit score completely. We'll show you what the lenders are really looking for, how the scores are actually calculated, and the exact steps you can take starting today to build a credit profile that makes banks fight for your business. So let's pull back the curtain. The first thing you need to understand is that your credit score isn't a grade for your past financial behavior. It's not a judgment. It is a prediction. It's a single 3-digit number that tells a lender the statistical probability that you will be 90 days late on a payment within the next 24 months. That's it. It's a risk score. And when you're asking for hundreds of thousands of dollars, lenders are obsessed with risk. Now, you've probably seen your score on a free credit app or your credit card statement. Here's the first secret. That's probably not the score your mortgage lender will see. Most of those free services use something called a Vantage score. It's a great educational tool, but it's not the industry standard for mortgages. The heavyweight champion, the one that truly matters for your home loan, is the FICO score. And not just any FICO score. Lenders often use older, more sensitive FICO models specifically designed for mortgage lending. Models that weigh certain factors differently. This is why you hear people say, "My app said my score was 760, but the lender pulled a 725. It's because they're playing a different game with a different rulebook. To win this game, you need to understand how the points are scored. FICO is not a mystery box. They tell us exactly what they care about. It breaks down into 5 categories, and mastering them is the key to unlocking the best interest rates. The first, and by far the most important, is payment history. This accounts for a massive 35% of your score. This isn't just a piece of the pie. It's the entire crust holding everything together. One late payment, just one, can be a wrecking ball to your score, potentially dropping it by 60 to 100 points. And it can stay on your report for 7 years. Lenders see a late payment, especially a recent one, as a giant flashing red light. Tells them that under pressure, you might not pay them back. Think about it from their perspective. If you were late on a $300 credit card bill, why should they trust you with a $3,000 mortgage payment? The rule here is simple and non-negotiable. Pay every single bill on time, every single time. Set up auto-pay on everything. There is no strategy more powerful than this. The second biggest factor at 30% is called amounts owed, but what it really means is credit utilization. This is where most people get tripped up. It's the percentage of your available credit that you're currently using. You've probably heard the 30% rule. Keep your balances below 30% of your limit. That's okay advice, but for a mortgage, okay isn't good enough. You want to be exceptional. The FICO algorithm heavily rewards people who use a tiny fraction of their available credit. We're talking single digits. Below 10% is the goal. Here's why it matters so much. Someone with one credit card with a $10,000 limit, who owes $900, is at 9% utilization. They look stable. They have breathing room. Now, consider someone with a $1,000 limit who owes $300. They're at that safe 30%, but to the lender, they look much closer to their financial edge. High utilization signals financial stress. It whispers to the algorithm that you might be relying on credit to make ends meet. The pro tip here is monumental. Your credit card company typically reports your balance to the credit bureaus on your statement closing date, not your payment due date. This means even if you pay your bill in full every month, if you charge $2,000 on a card with a $3,000 limit for a few weeks, the system sees you at 66% utilization, crushing your score. The fix? Make a payment before your statement closes to knock that balance down to almost zero. The system will then report a tiny utilization percentage, and your score will soar. Next up, at 15%, is the length of your credit history. This is the average age of all your credit accounts. Lenders are like traditional employers. They value long-term, stable relationships. A long credit history shows you have a proven track record of managing debt responsibly over time. This is why one of the biggest mistakes you can make is closing your oldest credit card. You might think, I never use it, it's just clutter. But when you close that 10-year-old card, you're erasing your longest-running success story. The average age of your accounts plummets, and your score takes a hit. The lesson? Keep those old, no annual fee cards open. Put a small, recurring charge on them like a streaming service and set it to autopay. This keeps them active and working for you, silently boosting your score in the background. The final two pieces are smaller, but they still matter. Credit mix at 10% is about diversity. Lenders want to see that you can handle different types of credit successfully. A healthy mix includes both revolving credit, like credit cards, and installment loans like an auto loan or a student loan, where you pay a fixed amount each month. It demonstrates your financial versatility. And finally, new credit, also at 10%, looks at how recently and how often you've applied for credit. Every time you formally apply for a loan or a credit card, it results in a hard inquiry on your report. A single inquiry will only ding your score by a few points. But a flurry of them in a short period? That makes lenders very nervous. It looks like you're desperate for cash, what they call credit-seeking behavior. So, in the 6 to 12 months before you plan to apply for a mortgage, you need to go on a credit lockdown. No new car loans, no new credit cards, no financing a new sofa. Protect your score like a fortress. Now let's put this all together into an actionable plan. A credit score workout you can start today to be in peak condition for 2026. First, you need to know your real numbers. Don't rely on the free apps. Go to a service like myfico.com and pay the fee to pull your full report. Yes, it costs money, but it's the single best investment you can make in this process. You'll see all the different FICO scores, including the exact mortgage-specific scores that lenders will use. This is your true starting line. Second, if you have any past due accounts, handle them immediately. Call the creditor, work out a payment plan. Do whatever it takes to get them marked as paid. A paid collection is infinitely better than an open one. Third, execute the utilization takedown. Go through all your credit cards and get the balances under 10%. If you can't pay them down, consider calling your credit card company and asking for a credit limit increase. If they double your limit, you've instantly cut your utilization in half without paying a dime. Fourth, for those with a thin or damaged credit file, there are two powerful strategies. One is a credit builder loan. These are small loans offered by credit unions where the money you borrow is held in a savings account. You make small monthly payments, and once it's paid off, the money is released to you. It's a foolproof way to build a perfect payment history from scratch. The second, more powerful strategy is to become an authorized user on a family member's credit card. If your parent or spouse has a 20-year-old credit card with a huge limit and a perfect payment history, being added as an authorized user can essentially graft that positive history onto your own credit report. The age of their account and their low utilization can dramatically increase your score in as little as 30 to 60 days. By systematically addressing these 5 pillars, you're not just hoping for a good score. You are reverse engineering one. You are speaking the lender's language. You're transforming your credit report from a simple history into a powerful marketing document for your own financial responsibility. But here's the crucial truth. You could do all of this. You could build a flawless credit profile and achieve a spectacular 800 FICO score. You could walk into that lender's office with the confidence of a financial titan and still get flat out denied for a mortgage. Why? Because your credit score, as critical as it is only one side of the coin. It proves you're willing to pay your debts. But the bank has another, even bigger question to answer. Are you able to? That question is answered by the single most important metric in your entire mortgage application. A number that can make or break your homeownership dreams, regardless of your credit score. In the next part, we will dissect this number. We're going to pull apart your income, your debts, and the all-powerful debt-to-income ratio. We'll show you how lenders calculate it, the hidden income sources you can actually use, and the strategies to structure your finances so that on paper, you look like the safest bet the bank has ever seen. Let's start with a simple thought experiment. Two people, Alex and Ben, both make exactly $100,000 a year. They have identical, excellent credit scores. They both walk into the same bank on the same day to apply for a mortgage. Alex gets pre-approved for a $500,000 home. Ben gets rejected for a $200,000 condo. What happened? What's the invisible force at play here? It's not income. It's not credit. It's the single most misunderstood, yet most powerful number in mortgage lending, your debt-to-income ratio, or DTI. This isn't just a piece of financial jargon. It's the gatekeeper that decides whether you get the keys to your dream home or a polite rejection letter. Lenders live in a world of risk. When they lend you hundreds of thousands of dollars, their biggest question isn't, how much do you make? It's how much of what you make is already spoken for. They want to see how much breathing room you have in your budget each month. Your DTI is their financial MRI. It tells them with cold, hard numbers if you can truly afford the new mortgage payment on top of your existing life. A high income is great, but if it's all flying out the door to service other debts, you look like a high-wire act with no safety net. A lower income but with minimal debt? To a lender, that looks like a stable, safe, and profitable investment. So let's demystify this number for good. The calculation itself is surprisingly simple. Your DTI is your total monthly debt payments divided by your gross monthly income. Gross, not net. That's your income before taxes, health insurance, and 401k contributions are taken out. Let's say you make $6,000 a month before taxes, and your total monthly debt payments are $2,100. You divide $2,100 by $6,000, and you get 0.35. Multiply by 100, and your DTI is 35%. Simple, right? But the devil is in the details of what counts as debt and what counts as income. Lenders actually look at two DTIs. The first is the front-end ratio. This is just your future housing payment. It's made up of 4 parts, known as PITI: principal, interest, taxes, and insurance. That's the core cost of owning the home. The second, and the one that really matters, is the back-end ratio. This is the big one. It's your PITI plus all your other monthly debt obligations that appear on your credit report. We're talking about your car payment, your student loan payments, the minimum payments on all your credit cards, any personal loans, alimony, or child support you pay out. What's not included is just as important. Your cell phone bill, car insurance, utilities, groceries, streaming subscriptions, none of that is counted in the DTI calculation. This is a common mistake. People think, I can't afford a mortgage because my monthly bills are too high. But a lender doesn't care about your Netflix subscription. They care about the $500 per month payment on your brand new truck. Now for the magic numbers. What DTI are lenders looking for? For decades, the gold standard was the 28 of 36 rule. No more than 28% of your gross income on housing, and no more than 36% on all your debts combined. While that's still a fantastic target for your own financial health, the reality of the 2026 market is different. For most conventional loans, the ones backed by Fannie Mae and Freddie Mac, lenders will often go up to a 43% back-end DTI. Some will even stretch to 45 or even 50% if you have compensating factors, like a massive down payment or significant cash reserves. And this is where the game changes. Government-backed loans are designed to help people who might not fit the perfect conventional mold. An FHA loan, for example, can often be approved with a DTI as high as 50%, sometimes even higher. A VA loan for our veterans? It's famously flexible on DTI, often allowing ratios well over 50% if other factors look good. Understanding these different thresholds is like knowing the cheat codes. It opens up different levels of borrowing power you might not have known you had. So what if your DTI is too high? This is not a dead end. This is where the strategy begins. You have 2 levers to pull. You can decrease your debt, or you can increase your income. Let's start with debt, because this is where you can make the fastest, most dramatic impact. Most people think the best strategy is to pay down their highest interest debt like a credit card. And for your personal finances, that's usually true. But for a mortgage application, it's wrong. Lenders don't care about your interest rates. They care about your minimum monthly payments. Your mission is to eliminate as many monthly payments as possible. Forget the avalanche or snowball method for a moment. I want you to become a small loan sniper. Find your smallest loan. Maybe it's a personal loan with a $75 monthly payment, or a store credit card with a $30 minimum. Attack that loan with everything you've got and pay it off completely. Wiping out that $75 payment has the exact same impact on your DTI as paying down your $500 car payment by $75, but it's infinitely easier and faster to accomplish. By eliminating that line item from your credit report, you lower the numerator in your DTI equation permanently. Do this with 2 or 3 small accounts and you could shave critical percentage points off your DTI in just a couple of months. Now let's talk about the other lever: increasing your income. This is where we uncover the hidden money lenders will actually let you use. The key here is consistency and documentation. Do you have a side hustle driving for a rideshare service or doing freelance work? Most people assume they can't use that income. You can, but you need to show a 2-year history of earning it, typically proven with tax returns, specifically your Schedule C. The same 2-year rule applies to part-time jobs. If you've been working a weekend gig consistently for over 2 years, that income counts. What about bonuses or commissions? Lenders won't use a one-time bonus, but if you have a 2-year history of receiving them, they will typically average that income out over 24 months and add it to your monthly total. This can be a massive boost for people in sales or performance-based roles. Even income from sources like child support, alimony, or Social Security can be used, as long as it's documented by a court order or award letter, and there's proof it will continue for at least 3 more years. And here's a pro-level strategy: using rental income. If you already own an investment property, you can use that rental income to qualify. But what if you don't? If you're buying a multi-unit property, like a duplex or a triplex, you can often use the projected rent from the other units to help you qualify for the loan on the entire building. You can literally use the income from the house you haven't even bought yet to help you buy it. It's a powerful way to get your foot on the property ladder. By understanding how lenders see your finances, you can stop guessing and start engineering. You can strategically pay down small debts to wipe out monthly payments. You can gather the right paperwork to prove your side hustle is a legitimate, stable source of income. You can shift your financial picture from risky to ideal without actually changing your salary. You are taking control of the narrative, presenting the strongest possible version of your financial self to the bank. You've now mastered the flow of money, your income, and your debts. You know how to structure them to make you look like the perfect borrower on paper. But there's one more giant piece of the puzzle we have to solve before we can get that pre-approval letter. It's the question that keeps most aspiring homebuyers up at night. Where does the money to actually buy the house come from? The down payment is the next great hurdle, surrounded by myths and misinformation. And in the next part, we're going to shatter the biggest myth of all, the idea that you absolutely need 20% down, and show you the programs and strategies that can get you into a home with far, far less. For decades, it's been the unwritten law of American homeownership, a piece of financial gospel passed down from our parents and their parents before them. You must, absolutely must, save up 20% for a down payment. Anything less was considered reckless, unprepared, a sign you weren't ready. This single belief has been the #1 dream killer for aspiring homebuyers, a towering wall that seemed impossible to climb. Well, I'm here today to tell you that wall is made of paper. The 20% down rule is the biggest, most persistent, and most damaging myth in real estate today. The truth is, the idea of putting 20% down isn't about being ready to own a home. It was never about that. It has always been about one thing and one thing only: protecting the lender. When you put down less than 20%, the lender sees you as a slightly higher risk. So, to cover themselves, they require you to pay for an insurance policy. That's it. That's the big secret. The 20% figure isn't a magic number for financial stability. It's simply the threshold where lenders stop requiring you to pay for their insurance. Once you understand that, the entire landscape changes. The question is no longer, how will I ever save $50,000, $60,000, or $100,000? The question becomes, which low down payment strategy is the right one for me? And today we are going to walk through the most powerful tools available to 2026 homebuyers that can get you into a house with as little as 3.5% down, or in some cases with absolutely nothing down at all. Let's start with the workhorse of the low down payment world, the FHA loan. FHA stands for the Federal Housing Administration, And they don't actually lend you money. Instead, they insure the loan for the bank. Think of the FHA as a co-signer for the entire country. Because the government is backing the loan, lenders are willing to approve buyers they might otherwise consider too risky. This means FHA loans are fantastic for people who have a steady income, but maybe not a perfect credit score or a huge pile of cash in the bank. The minimum credit score requirements are often lower than for conventional loans, and the big headline number. The minimum down payment is just 3.5%. Let's put that into perspective. On a $300,000 home, the mythical 20% down payment is $60,000. For most people, that's years and years of disciplined, difficult saving. With an FHA loan, the down payment on that same $300,000 house is $10,500. Now, that's still a significant amount of money, but for many, it transforms the impossible into the possible. It changes the timeline from a decade of saving to maybe a year or two. This is the single biggest key that has unlocked homeownership for millions of Americans. Now, what if I told you we could get that number even lower? What if we could get it to zero? For a very specific and deserving group of Americans, that's not a dream. It's a reality. I'm talking about the VA loan. If you are a veteran, an active duty service member, or an eligible surviving spouse, this is without question the most powerful mortgage product on the planet. It was created as a thank you, a way to help those who have served our country achieve the American dream they fought to protect. The VA loan has two almost unbelievable benefits. First, and most famously, it requires 0% down. Not a single dollar. You can finance the entire purchase price of the home. For someone leaving the military and starting a new civilian life, this benefit is life-changing. It removes the single largest barrier to entry. The second major benefit? The VA loan does not have monthly mortgage insurance. We'll talk more about what that is in a minute, but trust me, this saves you hundreds of dollars every single month compared to other low down payment options. There is a one-time funding fee that can be rolled into the loan amount, but many veterans are exempt from this fee entirely. If you have any connection to the military, the very first thing you should do is check your eligibility for a VA loan. It is a benefit you have absolutely earned. But what if you haven't served in the military? Is there still a path to a zero down payment loan? For millions of Americans, the answer is yes, and it's one of the best-kept secrets in the mortgage industry. The USDA loan. When people hear USDA, the United States Department of Agriculture, they think of farms and tractors. But the USDA Rural Development Loan Program is about so much more. Its mission is to help develop smaller communities across America. And to do that, they offer zero down payment mortgages to eligible buyers in designated areas. And here's the secret. The USDA's definition of rural is incredibly broad. It includes vast swaths of suburban America, small towns, and communities just outside major metropolitan areas. We're not talking about buying a cornfield in the middle of nowhere. We're talking about beautiful homes with yards in great school districts that are just a short commute from city centers. You can go on the USDA's website right now and type in an address to see if it's in an eligible area. You will be shocked at how much of the country qualifies. There are income limits for the program, but they are generous for most middle-class families. A zero down payment loan with competitive interest rates? The USDA loan is a hidden gem you absolutely need to investigate. Okay, so we have FHA for flexibility, VA for veterans, and USDA for designated areas. But what about the good old-fashioned conventional loan? The one everyone thinks requires 20% down? Well, the myth is wrong there too. For decades, major players like Fannie Mae and Freddie Mac have offered conventional loan programs with down payments as low as 3%. Programs like the conventional 97 loan, meaning you finance 97% of the home's value, are widely available. These are fantastic options for buyers with strong credit scores who simply haven't had time to save a massive down payment. Think of a recent college graduate with a great new job, or a young couple who has been diligent about paying their bills on time. A conventional loan with 3 or 5% down allows them to leverage their good credit history to get into a home sooner, without the specific requirements of a government-backed loan. So, you have all these incredible options: 3.5%, 3%, even 0% down. Sounds too good to be true. And this is where we have to talk about the catch. The trade-off. The price you pay for not putting down 20%. It's called private mortgage insurance, or PMI. PMI is the reason the 20% rule ever existed in the first place. It's an insurance policy, but it doesn't protect you. It protects the lender. If you default on your loan, the PMI policy pays the lender to help cover their losses. and you are the one who pays the monthly premium for it. This premium is added to your monthly mortgage payment and can cost anywhere from $50 to over $200 a month, depending on your loan amount, down payment, and credit score. FHA loans have their own version called a mortgage insurance premium, or MIP, which works in a similar way. This is the trade-off. You get into a home with less money down, but you have a higher monthly payment because of this insurance. But here is the critical piece of information, the part that makes this strategy so powerful. On a conventional loan, PMI is not permanent. Once you have paid down your mortgage to the point where you have 20% equity in your home, either through your regular payments or because the home's value has increased, you can request to have the PMI removed. It vanishes. Your monthly payment goes down and you continue on your way. You use PMI as a tool, a temporary bridge to get you into the home, and now you're done with it. This is the modern path to homeownership. It's not about waiting a lifetime to scrape together a legendary down payment. It's about understanding the tools at your disposal. It's about seeing the down payment not as an insurmountable wall, but as a strategic variable. You can use an FHA loan to get in with a low down payment and a flexible credit score. You can use a VA or USDA loan to get in with absolutely nothing down. Or you can use a low down payment conventional loan, pay PMI for a few years, and then have it removed. The 20% rule is dead. Knowing these options gives you power, gives you control. But getting approved for these amazing loans isn't just about finding the right program. It's about passing the lender's ultimate test, your credit score. That 3-digit number holds the key to your approval, your interest rate, and how much you'll ultimately pay for your home. And in the next part, we are going to decode that number completely. We'll break down exactly what lenders are looking for, how to understand your own credit report, and reveal the specific steps you can take, starting today, to make your score undeniable. So that 3-digit number, that single score that can feel like a gatekeeper standing between you and the keys to your first home. It's not just a number. It's your financial reputation boiled down to a score between 300 and 850. Think of it as a trust score. It's the lender's quickest way to answer one critical question. If we lend you hundreds of thousands of dollars, how likely are we to get it back? Your score tells a story, and our goal is to make sure it's a bestseller. First, let's clear up a common point of confusion. You don't have just one credit score. You have many. The 3 main storytellers, the major credit bureaus, are Experian, Equifax, and TransUnion. Each one collects information about your financial history and compiles it into a credit report. Because they don't always get the same information at the same time, your scores from each bureau can be slightly different. When you apply for a mortgage, lenders typically pull your reports from all 3 and use the middle score. So if your scores are 720, 740, and 750, they're going to base their decision on that 740. This is why you can't just focus on one. You need a holistically strong credit profile. Now, how is this magical number actually calculated? It's not a secret formula locked in a vault. The most common scoring model, the FICO score, is based on 5 key factors, each with a different weight. Understanding these is like getting the answer key to the test. The first and most important factor, making up a massive 35% of your score, is your payment history. This is the heavyweight champion. It is the single most critical piece of your financial story. Do you pay your bills on time? Every time. This includes credit cards, car loans, student loans, and yes, previous mortgages. A single late payment, especially one that goes over 30 days past due, can drop your score significantly and stay on your report for 7 years. Bankruptcies, foreclosures, and collections are devastating blows in this category. The message here is brutally simple. On-time payments are non-negotiable. This is the foundation upon which your entire score is built. Next up, accounting for 30% is amounts owed, more commonly known as your credit utilization. This sounds complicated, but it's just the ratio of how much credit you're using compared to how much you have available. Imagine you have one credit card with a $10,000 limit. If you have a $5,000 balance on it, your utilization is 50%. If you have a $1,000 balance, it's 10%. Lenders see high utilization as a red flag. It suggests you might be overextended and relying too heavily on debt to manage your finances. The golden rule is to keep your overall utilization and your utilization on each individual card below 30%. But the real pro-level tip? Aim for under 10%. People with the highest credit scores, the 800+ club, almost always keep their credit utilization in the single digits. It shows you have access to credit but the discipline not to use it. The third factor, worth 15%, is the length of your credit history. This is all about time. How long have your credit accounts been open? What's the average age of all your accounts? A longer credit history is like a long-term relationship. It demonstrates stability and provides more data for the lender to see you're reliable. This is why one of the worst mistakes you can make is closing your oldest credit card, even if you don't use it anymore. Closing that account erases a huge chunk of your positive history and can actually lower your score. Age is your ally here. It proves you've been a responsible player in the credit game for a long time. Coming in at 10% is your credit mix. Lenders like to see that you can successfully manage different types of credit. There are two main categories: revolving credit, like credit cards and lines of credit, and installment loans like auto loans, student loans, or mortgages, where you pay a fixed amount for a set period. Having a healthy mix of both shows you're a versatile and responsible borrower. This doesn't mean you should go out and get a car loan just to improve your mix. But if you only have credit cards or only have student loans, it's something to be aware of. Over time, naturally diversifying your credit types will help this part of your score. Finally, the last 10% is based on new credit. This category looks at how recently and how often you've applied for new credit. When you apply for a mortgage, a car loan, or a new credit card, it typically results in a hard inquiry on your report, which can temporarily dip your score by a few points. One or two inquiries aren't a big deal, but a flurry of applications in a short period of time makes you look desperate for credit, which is a major red flag for lenders. This is why you absolutely must avoid opening any new lines of credit. No new store cards, no new car loans. In the 6 to 12 months leading up to your mortgage application, let your credit profile rest and stabilize. So now you know the 5 pillars. But theory is useless without action. Your first mission is to become the world's foremost expert on your own credit report. By law, you are entitled to a free copy of your report from all 3 bureaus once a year. The only place you should go to get it is annualcreditreport.com. This is the official government-mandated site. When you get your reports, you're not just looking for the score. You're putting on your detective hat. Scrutinize every single line item. Is your name spelled correctly? Are all the accounts listed actually yours? Look at the payment history for every account. Do you see a late payment listed that you know you paid on time? Mistakes happen more often than you think. A simple clerical error, a case of mistaken identity, or outright fraud could be dragging your score down. If you find an error, you have the right to dispute it with the credit bureau. This is one of the fastest ways to potentially see a huge jump in your score. Once you've audited your report and disputed any errors, it's time to build. Here are the exact steps to make your score undeniable. Step 1. Automate everything. Go into every single one of your credit card and loan accounts online and set up automatic payments for at least the minimum amount due. This creates a safety net, guaranteeing you will never, ever have a late payment again. You can and should still pay more than the minimum, but this ensures the foundation is protected. Step 2. Attack your credit card balances. Your focus is on that utilization ratio. If you have cards with balances over 30% of the limit, prioritize paying them down aggressively. Start with the card that has the highest interest rate to save the most money, or start with the smallest balance to get a quick psychological win. Either way, chipping away at that debt will directly and positively impact 30% of your score. Step 3. Ask for a credit limit increase. Call the number on the back of your existing credit cards, especially ones you've had for a while and have a good payment history with. Ask them for a credit limit increase. In many cases, they can do this without a hard inquiry. If they raise your limit from $5,000 to $10,000, and your balance stays the same, you have instantly cut your credit utilization ratio in half. It's one of the most powerful and underutilized tricks in the book. Step 4. Don't make sudden moves. As we discussed, don't open a bunch of new accounts. And just as importantly, don't close your old ones. Let your accounts age. Let your positive payment history grow. Time is a powerful force for building good credit. Following these steps transforms your credit score from something that happens to you into something you actively control. And the payoff is immense. A person with a 640 credit score might get a mortgage interest rate of 7.5%. But a person with a 760 score could qualify for a rate of 6.5%. On a $400,000 loan, that 1-point difference doesn't just sound small. It saves you over $250 every single month. Over the life of the loan, that's over $90,000. $90,000. All because you took the time to understand and master this one number. Now that your credit score is on the path to becoming undeniable, we need to talk about the other giant number in the room: the cash you need up front. In the next part, we're going to demystify the down payment. We'll explore every option from zero-down loans to the classic 20%. And I'll reveal the hidden costs that catch almost every first-time buyer by surprise. Let's start with the biggest myth in American real estate: the 20% down payment. You've heard it 1,000 times. Your parents told you, your friends told you, every article online seems to scream it from the rooftops. You need 20% down to buy a house. I'm here to tell you that, for a huge number of homebuyers in 2026, that is simply not true. It's a relic, a ghost of mortgages past. The 20% figure became the gold standard for one simple reason: to avoid something called private mortgage insurance, or PMI. We'll dive deep into that in a minute. But the idea that you are locked out of homeownership without a massive pile of cash is a dream killer. And it's outdated. The modern mortgage landscape is designed with a variety of on-ramps to homeownership. Your job is to find the one that fits your financial vehicle. So let's blow the doors off the 20% myth and look at the real-world options you have right now. First up, the workhorse of the low down payment world: the FHA loan. Backed by the Federal Housing Administration, these loans are specifically designed to help first-time homebuyers and those with less than perfect credit get into a home. The magic number here? 3.5%. On a $400,000 house, that's a down payment of $14,000, not the $80,000 everyone talks about. That is a life-changing difference. FHA loans are more forgiving on credit scores and debt-to-income ratios, making them incredibly accessible. But there's a trade-off, and it's a big one. FHA loans require you to pay mortgage insurance, both as an upfront premium that's rolled into your loan and as a monthly fee. And here's the critical part. For most FHA loans today, that monthly mortgage insurance payment lasts for the entire life of the loan. You'll be paying it for 30 years unless you refinance into a different type of loan later on. Now, what if you have good credit, but just haven't saved up a huge down payment? Enter the conventional 97 loan. This is the conventional loan world's answer to the FHA. It allows you to buy a home with just 3% down. That's even less than an FHA loan. So, on that same $400,000 house, your down payment is just $12,000. Because it's a conventional loan, the credit requirements are stricter than FHA. You'll typically need a credit score in the mid to high 600s or better. And yes, because you're putting down less than 20%, you will have to pay PMI. But, and this is the game changer, unlike FHA, the PMI on a conventional loan automatically cancels once your loan-to-value ratio reaches 78%. In other words, as you pay down your mortgage and your home's value increases, that extra monthly fee eventually disappears. This makes the 3% down conventional loan a powerful long-term strategy for disciplined buyers. But what if I told you the down payment could be zero? Not a typo. Zero. For millions of Americans, this is a reality. If you are a veteran and active duty service member, or an eligible surviving spouse, the VA loan is, without a doubt, one of the best mortgage products ever created. It requires 0% down. You can finance the entire purchase price of the home. There's no monthly mortgage insurance, which is a massive savings. The interest rates are typically some of the most competitive on the market. Now, there is something called a VA funding fee, which is a percentage of the loan amount paid to the VA to keep the program running. However, this fee can often be rolled into the loan amount, and many veterans with service-related disabilities are exempt from it entirely. If you are eligible for a VA loan, you need to look at it very, very closely. There's one more zero-down option we need to talk about: the USDA loan. Backed by the U.S. Department of Agriculture, these loans are designed to promote homeownership in rural and, surprisingly, many suburban areas. You'd be shocked at the number of towns just outside major metro areas that qualify. Like the VA loan, it requires 0% down. The catch? There are two. First, there are income limits. You can't make too much money to qualify. Second, the property itself must be located in a USDA-eligible area. You can find maps online to check specific addresses. If you meet the income and location requirements, a USDA loan is an incredible path to homeownership with no down payment. So, with all these fantastic low and zero down options, why would anyone ever scrape and save to put 20% down? Is it just a flex? No. There are powerful, concrete financial advantages to making a larger down payment if you can. First, as we mentioned, you completely avoid PMI. that private mortgage insurance on a conventional loan can cost anywhere from 0.5% to over 1.5% of the loan amount per year. On a $400,000 loan, that could be an extra $150 to $500 tacked onto your payment every single month. That's cash you're lighting on fire. It doesn't go towards your principal, it doesn't build equity. It's purely to protect the lender because they see you as a higher risk. Putting 20% down eliminates this cost from day one. Second, a larger down payment means a smaller loan. A smaller loan means a smaller monthly payment period. This frees up your cash flow for other investments, savings, or just living your life. It also means you pay significantly less in total interest over the life of the loan. Third, you start with more equity. Equity is the portion of your home you actually own. It's your home's value minus your loan balance. With 20% down, you walk in the door with a significant ownership stake, which protects you from market fluctuations and can be tapped into later through a home equity loan if you need it. Finally, a large down payment makes you a stronger borrower in the eyes of the lender. This can sometimes unlock a slightly better interest rate, saving you even more money over the long haul. So the down payment isn't a one-size-fits-all rule. It's a strategic choice. It's a spectrum from 0% all the way to 20% and beyond. Your job is to analyze these options and decide where you fit. But here is the single biggest mistake I see first-time homebuyers make. They focus so intensely on saving for the down payment that they completely forget about the other mountain of cash they need to bring to the table. This is the surprise that derails deals and shatters dreams. I'm talking about closing costs. Your down payment is not the total cash you need. Not even close. Closing costs are the fees you pay to all the parties involved in finalizing the real estate transaction. Think of it as the cost of doing business. These costs typically range from 2 to 5% of the home's purchase price. So on that same $400,000 house, you need to plan for an additional $8,000 to $20,000 in cash, on top of your down payment. What's in this bucket of fees? Things like the loan origination fee, which is what the lender charges for creating the loan. The appraisal fee, to have a professional verify the home's value. Title insurance, which protects you and the lender from any future claims on the property's ownership. There are attorney fees, recording fees paid to the county, survey fees, and more. It's a long list, and your lender will give you an official loan estimate that itemizes every single one. And we're still not done. You also have to fund your escrow account. Most lenders require you to pay a few months of property taxes and homeowners' insurance premiums up front. They put this money into a special savings account, the escrow account, and they'll use it to pay your tax and insurance bills on your behalf when they're due. This ensures the bills get paid and protects their investment. This is often referred to as prepaids, and it can add another couple $1,000s to your cash-to-close requirement. Let's put it all together. You want to buy a $400,000 house using a 3.5% down FHA loan. Your down payment is $14,000. Let's estimate your closing costs and prepaids at a conservative 3%, which is $12,000. The total cash you need to bring to the closing table isn't $14,000. It's $26,000. That's a massive difference, and if you're not prepared for it, it's a brutal shock just weeks before you're supposed to get the keys. Now you have the full picture. The down payment is just one piece of the puzzle. The real number you need to save is your down payment plus your closing costs. Understanding this distinction is the difference between a smooth, successful home purchase and a last-minute panic scramble for cash. You now know the truth about down payments and the hidden costs that lurk behind them. But getting your money right is only half the battle. Now you have to convince a lender to actually give you the loan. You have to survive the mortgage application gauntlet, a grueling process of paperwork, verification, and underwriting where every single detail of your financial life is put under a microscope. In the next part, we're going into the trenches of the loan application. I'll show you exactly how to prepare your documents, what underwriters are really looking for, and the critical mistakes that get applications denied at the final hour. This is where the theoretical meets the tactical. You've got your pre-approval, you found a house, your offer is accepted. The champagne is on ice, but it is not time to pop the cork. Not yet. Now, you enter the gauntlet of the official mortgage application and underwriting. This is the final boss battle, and your weapon is a well-organized stack of paper. First, let's talk documents. Your lender will give you a checklist and it will feel invasive. They want to know everything. But it's not personal, it's procedural. They are building a story about you, a financial biography, and every document is a chapter. Let's break down the main characters in this story. You'll need your most recent pay stubs, typically for the last 30 days. Why? This proves your current income. It shows your gross pay, your deductions, and your net pay. The underwriter is looking at this to confirm the income you stated on your application is real and current. Next, W-2s and tax returns, usually for the past 2 years. The W-2s show your employment history and year-over-year income from a specific employer. The tax returns provide the big picture. If you're a standard W-2 employee, this is straightforward. But if you have side hustles, freelance income, or own a small business, your tax returns are the gospel. This is where you prove that income is stable and likely to continue. Underwriters will often average the income from the last 2 years, so be prepared to explain any major dips or jumps. Then come the bank statements. All of them. Checking, savings, investment accounts, 401k statements, usually for the last 2 to 3 months. This is the part that feels most intrusive. But the underwriter isn't judging you for that late-night pizza order. They are doing 2 things: verifying your assets and sourcing your down payment. They need to see that you have the cash for the down payment and closing costs, and this is critical, they need to know where that money came from. It needs to be seasoned, meaning it's been sitting in your account for a while. A sudden massive deposit of $10,000 a week before you apply? That's a giant red flag we'll talk about in a minute. This collection of documents is your opening argument. It's your evidence. Present it cleanly, completely, and quickly. Don't send blurry photos from your phone. Scan everything and label the files clearly. The easier you make the underwriter's job, the smoother your journey will be. Now let's pull back the curtain and understand the person reviewing this file. The underwriter. The underwriter is not your enemy. Their job is not to find a reason to deny you. Their job is to build a case, using your documents, that proves to the bank you are a responsible borrower and a good risk. They are the final gatekeeper, and they operate on a framework often called the 3 Cs of credit, capacity, credit, and collateral. First is capacity. This is the simplest question. Can you actually afford to pay this loan back month after month for the next 30 years? The primary metric here is your debt-to-income ratio, or DTI. We talked about this before, but now it's under a microscope. The underwriter will take your total proposed housing payment, principal, interest, taxes, insurance, and HOA fees, and add it to all your other monthly debt payments, car loans, student loans, credit card minimums. They divide that total by your gross monthly income. That percentage is your DTI. They are verifying every single number. They see that you claimed your car payment is $400, but your credit report says it's $450. They will use the $450. They see a credit card you forgot to list. They will add it. Capacity is about the cold, hard math of your cash flow. Second is credit. They have your credit report and your score. But the underwriter looks deeper. The score is just the headline, they read the whole article. A 740 score is great, but a 740 score with a recent 60-day late payment on a car loan tells a different story than a clean 740. They are looking for patterns. Do you consistently pay on time? How much of your available credit are you using? That's your utilization ratio. High utilization signals financial stress. A collection account from a medical bill 5 years ago is one thing. A credit card charged off 3 months ago is a deal killer. Your credit history is your financial resume, and the underwriter is the hiring manager. The third C is collateral. This isn't about you, it's about the house. Is the asset the bank is lending you hundreds of thousands of dollars for actually worth that much? This is determined by the appraisal. A licensed appraiser will assess the property, compare it to similar, recently sold homes in the area, the comps, and issue a report with a valuation. If you offered $400,000 and the house appraises for $400,000 or more, you're golden. But if it appraises for $380,000, you have a problem. The bank will only lend based on the appraised value. This appraisal gap has to be covered, either by you bringing more cash to closing, the seller lowering the price, or some combination of the two. If you can't bridge that gap, the deal can fall apart. So the underwriter is balancing these 3 Cs: your ability to pay, your history of paying, and the value of the asset securing the loan. Your job is to provide them with clear, undeniable proof in all 3 categories. This brings us to the critical mistakes. These are the unforced errors, the self-inflicted wounds that sabotage perfectly good applications at the very last minute. Please burn these into your memory. Mistake number 1. Making a major purchase. The period between your loan application and your closing day is a financial quiet period. Do not, I repeat, do not go out and buy a new car. Don't finance a living room full of furniture. Don't max out a credit card on a vacation. Why? Any new debt screws up your DTI. The lender will do a final credit check right before closing. When they see that new $600 a month car payment, your DTI, which was approved at 43%, might shoot up to 48%, and your loan will be instantly denied. You could be hours from getting the keys and have the rug pulled out from under you. Just wait. The car can wait. The sofa can wait. Mistake number 2. The mystery deposit. As we mentioned, underwriters need to source all large deposits. If your parents give you $20,000 for the down payment and you just move it into your checking account, it looks like an undisclosed loan to the underwriter, which would impact your DTI. All gift funds must be documented with a gift letter, a simple form where the person giving the money signs a statement that it is a true gift and not a loan that needs to be repaid. Any large deposit that isn't from your payroll needs a paper trail. Sold your old car? Show the bill of sale and the deposit slip. Got a bonus from work? Show the pay stub that reflects it. Unexplained cash is a death sentence for a mortgage application. Mistake number 3. Changing your employment situation. Lenders crave stability. They just approved you based on your job as a salaried marketing manager at a stable company. Now is not the time to quit that job to become a freelance artist. Changing jobs in the same field for a similar or higher salary is usually okay, but you must inform your lender immediately. But switching from a W-2 employee to a 1099 independent contractor? That's a massive red flag. They can't verify that new income stream is stable, and your file will likely go right into the denial pile. Don't even change the way you are paid, like moving from salary to commission without talking to your loan officer first. And the final mistake, the simplest one to avoid, going dark. Your loan officer or the processor will ask for things: an updated bank statement, an explanation for an old address on your credit report, a copy of your divorce decree. Respond to them immediately. Every day you delay is a day your closing is delayed. Underwriting moves at the speed of your responsiveness. An underwriter waiting on a document from you will simply put your file aside and work on someone else's. Be a partner in the process. Answer the calls. Reply to the emails. Send the documents the same day they're requested. Navigating underwriting isn't about being perfect. It's about being prepared, transparent, and responsive. You're building a case for your own creditworthiness. Provide the evidence, tell a clear story with your finances, and avoid these critical last-minute mistakes. Do that, and you'll trade that stack of paperwork for a set of house keys. Once you have that final approval, that glorious notification known as clear to close, the finish line is in sight. But the final lap is filled with its own unique hurdles. Deciphering the closing disclosure, understanding title insurance, and navigating the final walkthrough. In the next part, we'll demystify the closing process itself, ensuring you don't stumble just before you get the keys to your new home. So let's break down this final boss battle of home buying. You've navigated inspections, appraisals, and underwriting. Now you're standing at the gates of the last level, the closing table. This is where a house officially becomes your home, but it's also where small mistakes can cause massive last-minute headaches. First up is the most important document you'll see at this stage: the closing disclosure, or CD. You'll remember we talked about the loan estimate, which was the bank's best guess of your costs. The closing disclosure is not a guess. It is the final itemized bill for your home purchase. It lists every single cent you need to bring to the table and every credit you're receiving. Now, here is a piece of federal law designed specifically to protect you: the 3-day rule. Your lender is legally required to give you the final closing disclosure at least 3 full business days before your scheduled closing date. This is not a suggestion, it's your right. This 3-day window is your golden opportunity. It's your time to review every line item without the pressure of a notary staring at you, pen in hand. When you get that document, your mission is to compare it line by line against the last loan estimate you received. Your interest rate, your loan amount, your monthly payment, do they match? If not, you need to find out why immediately. Most of the numbers should be identical or very, very close. You will see some changes, and that's normal. For example, you'll see prorated property taxes, which are adjusted based on the exact day of the month you're closing. You might see a final credit from the seller for a repair you negotiated. These are expected. What you're looking for are the red flags: a sudden jump in your interest rate that was supposed to be locked, a new mysterious processing fee for thousands of dollars that was never mentioned before, a change from a fixed rate to an adjustable rate loan. If you see something that makes your stomach drop, do not wait. Pick up the phone and call your loan officer and your real estate agent. This is precisely why the 3-day rule exists, to catch and correct errors before you're legally on the hook. Don't be afraid to delay the closing if something is seriously wrong. It's better to postpone for a day or two to fix a $1,000 error than to sign it away forever. While you're in that 3-day window, you'll also conduct the final walkthrough. This is your last chance to see the property before it's yours. And let's be crystal clear about its purpose. This is not a second home inspection. The time for negotiating over a leaky faucet or a cracked tile is long gone. The final walkthrough serves 2 critical functions. First, to verify that the home is in the same condition it was in when you signed the contract. No new holes in the wall from moving out, no missing appliances, no flood in the basement. Second, it's to confirm that any repairs the seller agreed to make have been completed to your satisfaction. Bring your agent and a copy of your contract. Be methodical. Turn on every light switch. Run every faucet and check for hot water. Flush every toilet. Test the heat and the air conditioning regardless of the season. Open and close windows and doors. Check that the appliances included in the sale are still there and are the correct models. If the seller was supposed to fix the garage door opener, test it. If they were supposed to patch a hole in the drywall, inspect the patch. If you discover a major problem, like the seller's movers knocked a hole in the wall or the furnace has suddenly died, you have leverage. Your agent will immediately contact the seller's agent, and a solution will be found before closing, often in the form of a credit on your closing disclosure, so you can handle the repair yourself. Next, let's talk about title insurance. At closing, you'll be dealing with 2 policies. The lender's policy, which is required and protects the bank, and the owner's policy, which is for you. I cannot stress this enough. Get the owner's policy. It's a one-time fee paid at closing that protects you for as long as you own the home. Protects you from the past. It's an insurance policy against ghosts. It shields you from claims against your property from things that happened long before you were in the picture. An undiscovered heir from a previous owner, a forged signature on a deed from 1972, an unpaid tax lien from a decade ago. The title company does a thorough search to find these issues, but nobody is perfect. An owner's policy is your ultimate safeguard, ensuring that the home you're buying is truly, legally, and indisputably yours. Alright, the CD is accurate, the walkthrough is complete, and you understand your title insurance. It's time. You're heading to the closing itself. This usually happens at the office of a title company or a real estate attorney. You'll walk into a conference room and it might feel a bit like a summit meeting. There will be a closing agent, maybe your real estate agent, and sometimes the seller and their agent. You need to bring 2 critical things. First, your government-issued photo ID. A driver's license or passport will work. Bring 2 forms just in case. Second, you need the money. Your final cash-to-close amount is on the closing disclosure. You cannot bring a personal check. It's too much money and it needs to be guaranteed funds. You will need either a cashier's check from your bank, made out to the title company, or you'll need to wire the money. And this brings me to the single most important warning in this entire series. Listen closely because this could save you your entire life savings. We are talking about wire fraud. It is a massive, devastatingly effective scam. Here's how it works. Hackers will monitor real estate transactions. Days before your closing, they will send you an email that looks exactly like it's from your title company or attorney. It will have their logo, their signature, everything. The email will say something like, "There's been a last-minute change to our wiring instructions. Please use this new account and routing number." And just like that, unsuspecting buyers wire their entire down payment, tens or even hundreds of thousands of dollars, directly to a criminal's offshore account, where it vanishes forever. Here is how you defeat them. It is simple, but it is non-negotiable. You must never trust wiring instructions sent via email. Ever. When you are ready to wire your money, you must independently find the phone number for your title company, from their official website or from a document you received weeks ago. And you must call them and verbally confirm the account and routing numbers over the phone before you initiate the transfer. Do not use the phone number listed in the suspicious email. I'm going to repeat that. Get the number yourself, call them directly, and read the account numbers out loud to a live person to confirm they are correct. This one phone call can be the difference between closing on your dream home and financial ruin. Once your funds are confirmed, the main event begins. Signing the mountain of paperwork. It's going to feel like you're signing your name 100 times, and you probably are. Don't be intimidated. The closing agent's job is to walk you through it. The 2 most important documents are the promissory note, which is your personal IOU to the lender, your official promise to repay the loan, and the mortgage or deed of trust, which is the document that secures the property as collateral for that loan. It's what gives the lender the right to foreclose if you don't pay. You'll also sign countless other disclosures and affidavits. Take your time. Ask questions. If you don't understand what a document is, ask, "What am I signing here?" Or "Can you explain this paragraph in simple terms?" This is the final step. Don't rush it. And then it's done. The papers are signed. The money is transferred. The deal is funded. The closing agent will tell you that the deed is being sent to the county to be officially recorded. And at that moment, you are no longer a home buyer. You are a homeowner. Someone will slide a set of keys across the table. They're no longer just pieces of metal. They are the keys to your future, to your memories, to your new life. You did it. But grabbing those keys isn't the end of the story. It's the beginning of a brand new one. Now that you have the keys, what happens next? The journey of homeownership is just starting. Your first mortgage payment is looming, property taxes and insurance need to be managed, and now you have an asset you need to protect and grow. In the final part of our series, we'll cover what to do in your first year of homeownership, from making that first payment to understanding escrow, avoiding homeowner scams, and starting the wealth-building journey of growing your home equity. We're going to turn you from a savvy homebuyer into an even savvier homeowner. So the keys are in your hand. The moving truck is gone. The last pizza box has been thrown out. Congratulations. But now the real journey begins. That first mortgage payment is looming, and it's a little different than paying rent. Your first payment isn't usually due on the first of the next month. Because of how closing costs and prepaid interest are calculated, your first payment might be more than 30 days away. You'll get a statement from your new mortgage servicer. That's the company you actually send your money to, and it will clearly state the due date. Don't lose this. Set up automatic payments immediately. This is the single best thing you can do to protect your credit score. Now let's break down that payment. You'll see it's made up of 4 parts, often called PITI: principal, interest, taxes, and insurance. The principal is the part that actually pays down your loan balance. The interest is the lender's profit. But what about the T and the I? That money goes into a special holding account called an escrow account. Think of escrow as a forced savings account that your lender manages for you. Every month, you pay about 1/12 of your annual property tax bill and 1/12 of your annual homeowner's insurance premium into this account. Then when those big bills come due once or twice a year, the lender pays them on your behalf using the money you've saved in escrow. Why do they do this? It's simple: protection. The lender has a massive financial stake in your house. If you fail to pay property taxes, the county can put a lien on your home and even foreclose, putting them ahead of the lender. If you let your insurance lapse and the house burns down, their collateral is literally gone. Escrow ensures these critical bills are always paid on time. Each year, your servicer will do an escrow analysis. They'll look at what your taxes and insurance cost last year and project what they'll cost next year. If they collected too much, you'll get a check back, a nice little surprise. If they collected too little, maybe because your property taxes went up, you'll have a shortage. You'll typically have the option to pay that shortage in a lump sum, or have your monthly mortgage payment increased for the next year to cover it. Don't be alarmed when this happens. Tax and insurance costs rarely stay the same. It's a normal part of homeownership. Now, with ownership comes a new kind of vulnerability. Your name and address are now a public record, and scammers know this. They will target you. Within weeks of closing, you'll start getting mail that looks incredibly official. One of the most common scams is a letter about your mortgage protection insurance or final expense policy. It might even name your lender. This is almost always just a life insurance company trying to sell you a policy. Shred it. Another big one is a letter demanding a fee, maybe $95, to send you a certified copy of your property deed. This is a total scam. You already received the original deed at closing, and if you ever need a copy, you can get it from your county recorder's office for just a few dollars. Be wary of anyone offering to help you fight your property tax assessment for an upfront fee. While you can appeal your assessment, you can typically do it yourself for free. And finally, be cautious of unsolicited contractors who show up at your door after a storm, offering a free roof inspection. These are often storm chasers looking to pressure you into an insurance claim. Always work with local, vetted, and insured professionals. Your rule of thumb should be: if it's an unsolicited offer that demands immediate action or money, it's probably a scam. Okay, we've covered protecting your home. Now let's talk about growing your wealth. This is where the magic happens. The key is home equity. Equity is the difference between what your home is worth and what you owe on your mortgage. If your home is worth $400,000 and your loan balance is $300,000, you have $100,000 in equity. It's the single biggest driver of wealth for the middle class in America, and it grows in two primary ways. First, through appreciation. As the years go by, your home's value will likely increase due to inflation, market demand, and improvements you make. Second, and this is the part you control, is by paying down your loan principal. This is where understanding your amortization schedule becomes a superpower. Amortization is just a fancy word for the table that shows how each mortgage payment is split between interest and principal over the entire life of the loan. In the beginning, your payments are heavily skewed toward interest. For a $300,000 30-year loan at 7%, your first payment of about $2,000 might see over $1,700 go straight to interest, with less than $300 actually paying down your loan. It's depressing, I know, but here's the beautiful part. Every single month, that split shifts just a tiny bit. The next month, a little less goes to interest and a little more goes to principal. Fast forward 15 years, and you'll hit a crossover point where more of your payment is finally going toward principal than interest. By the final years of your loan, almost the entire payment is pure principal, building your equity at a rapid pace. But you don't have to wait 30 years. You can supercharge this process. The secret is making extra payments toward your principal. Even small amounts can have a jaw-dropping impact. Let's go back to that $300,000 loan. If you simply paid an extra $100 a month, right from the very beginning, you would pay off your mortgage 4 years and 5 months early, and you would save over $67,000 in interest. Think about that. The cost of a few pizzas and a Netflix subscription each month saves you the price of a luxury car. You can also try the bi-weekly payment strategy. Instead of making one monthly payment, you make a half payment every 2 weeks. Because there are 52 weeks in a year, this results in 26 half payments, which is the equivalent of 13 full monthly payments. That one extra payment per year can shave about 6 years off your mortgage and save you a fortune in interest. Just make sure your lender doesn't charge a fee for this service, and that the extra money is being applied directly to the principal. Always specify that any extra payment is for principal reduction. As your equity grows, it becomes a powerful financial tool. Down the road, you might consider a cash-out refinance, where you take out a new, larger mortgage and pocket the difference, perhaps to fund a major renovation or consolidate high-interest debt. Or you could open a home equity line of credit, or HELOC, which works like a credit card that uses your equity as collateral, giving you access to cash when you need it for emergencies or opportunities. These are advanced strategies for later in your journey, but it's important to understand from day one that your home is more than just shelter. It's a living, growing asset. It's a savings account you can live in. We've covered an immense amount of ground in this series, from understanding your credit score and getting pre-approved, to navigating the market, making an offer, surviving the closing process, and now stepping into the life of a homeowner. You went from a hopeful searcher to a key-holding owner. The process is complex, sometimes stressful, but it represents something foundational to the American dream. The ability to own a piece of the world, to build a stable foundation for your life, and to create a legacy of wealth for your family. This house is now your canvas. It's where memories will be made, where you'll measure your kid's height on a door frame, and where you'll build your future. You didn't just buy a house. You invested in yourself. You took a monumental step toward financial freedom. If this guide has given you the knowledge and the confidence to take that step, to turn the dream of homeownership into a plan, then our mission is complete. Your journey is just beginning. Make it a great one.